Hi, everyone, and thanks again to those that have joined already. My name is Michele Ferrario. I'm the co-founder and CEO of StashAway. Thanks so much for being on time. I think we can now start the session. Tonight, we're going to talk about cash. And cash has become a more important topic over the last 12 months. We're going to speak about it. The way we're structured the webinar is that I'm going to give a brief introduction about why is cash important in general, why is cash important today, and then I'm going to speak briefly about what StashAway offers in terms of cash management. And then we're going to open a conversation with two amazing guests that know everything about investing in short duration instruments, which are great for cash management. Here we have, let me introduce them quickly, and maybe I'll ask them to introduce themselves as well. So actually, if you can please also turn on the video, Wai Hung and To Che. So we have Wai Hung from Nikko Asset Management, as well as To Che from Lion Global. Thank you so much for joining tonight. Maybe Wai Hung, do you want to start and introduce yourself?
Hi, everyone. I'm Wai Hung. I'm basically one of the senior portfolio manager with Nikko Asset Management, basically focusing on the hard currency credit strategy for the firm here in Nikko.
Thank you, Wai Hung. And we also have To Che from Lion Global. Do you want to introduce yourself, To Che?
Yes, thank you for having us. Great to be here. My name is To Che. I'm the fixed income manager of Lion Global. I'm also the co-head of fixed income. We manage money for institutional clients and retail clients. And for this kind of products, we do invest into Singapore products. That's one of our forte.
Fantastic. Thank you so much for being here tonight. And as mentioned, we're going to structure the evening in kind of a 3 parts plus Q&A. I'll speak briefly about StashAway. I'll then move on to speak a little bit about what you can do with your money, your cash in this current environment. And then we're going to open up a conversation with To Che and Wai Hung. If you have any questions, please use the Q&A function available on Zoom. We're going to leave ample time to go through questions. The questions can be to all the panelists, or I'll moderate and make sure that the right question is asked to the right person. But please use the Q&A function. I'll try to get to as many questions as possible toward the end of the session. But let's start the conversation, and let's start with a quick introduction to StashAway for those of you that might not be familiar with us. So StashAway is the leading digital wealth manager operating across 5 geographies. We're in Singapore, Malaysia, Thailand, Hong Kong, and the UAE, in Dubai. In each of these 5 markets, we're licensed as a fund manager. So for instance, in Singapore, we have a CMS license for retail fund management. We have been live in Singapore since mid-2017. So it's now been close to 6 years. We've been here for quite a bit of time. As we grew over time, we were able to attract the interest of very high quality shareholders. So we're backed by Fidelity, one of the largest asset managers in the world. We're backed by Sequoia, one of the most prime VCs globally. We're backed by Hamilton Lane, which is one of the largest global players in private markets, as well by a few other players. I'm not gonna go through the accolades you see on the bottom left. Maybe the last one we received was particularly nice, which was the Financial Times High Growth Company. We're in the top 20 Asia Pacific and top 5 in Singapore from the Financial Times. And then on the bottom right side, you see our partner banks. This is where your monies and securities sit. So whenever you invest with StashAway, you never take any StashAway risk because your money and securities are segregated in custodian accounts at, depending on the product, might be DBS, Citi, or HSBC. Now, we offer a wide variety of products. I'm not going to go into the details of this. We have a few, a set of cash management products, which I'll talk about in a second. Our core product is what we call general investing. We have a set of portfolios managed by our systematic framework. We call it ERA, Economic Regime-Based Asset Allocation. These have been live since 2017, have done very well over the last 6 years. We have both the core ones as well as the ESG ones. Last year, we also launched a collaboration with BlackRock There are 4 portfolios where the asset allocation is managed by BlackRock. And then we also launch flexible portfolios, which enable clients to build their own portfolios, either tweaking our own asset allocation or starting from scratch. We have a few income portfolios as well as thematics. And for accredited investors, we offer access to private equity, angel investing, as well as crypto. But focus of tonight is, as I mentioned, on cash management. So we're going to talk about this for tonight. Now, the main question is, what can you do with your cash in this environment? But let's make a step back first. So how does cash play a role in a portfolio? So as you can see here, this is a kind of a somebody's portfolio, excluding your primary residence, and how it should be constructed. You want to have some cash, and I put a Y%. I'll talk about it in more detail in a second. You want to have most of your money in diversified liquid investments with equities, bonds, real estate, commodities. Depending on your risk level, you might have more equities or more bonds, for instance. And depending on the macro scenario, you might have different type of sub sector and sub geography asset allocation. Depending on your wealth and need for liquidity, you might have some money in private markets. We put it here at 0 to 25%. The wealthier you are, the more this percentage should be higher, and that's why, as I mentioned earlier, we offer private equity, venture capital, access to accredited investors. And then everybody want to play a little bit, so you might want to have some play money for your crypto investments or your single stocks investments, your bets on the fact that Elon Musk will conquer the war with Tesla or whatever your bet be. Okay, now I'll speak about the Y% in a second. But before I do that, let's address a little bit the elephant in the room. Should you keep investing in your portfolio during uncertain times? And we've now gone through uncertain times for 15, 18 months. 2022 was horrible for equity markets and actually fixed income markets. 2023 has been actually very good for both equity and fixed income, but there's always a lot of uncertainty in the air, particularly on the equity side. So what should you do here? And given we're talking about cash today, I just want to make it clear that you shouldn't use your cash position to time the market. You should always stick to your long-term main investing plan for that 60 to 90% of wealth that I mentioned earlier. We put down an example here of what would have happened in 2020 if you kind of took 2 different routes during the March COVID kind of crash. For 2 people that invested $100,000 during the COVID crash, the initial crash in February, markets went down around 20%. They went down a bit further in March. If you had 2 different people and one stayed investing, this is Samantha, and another one did not stay invested, this is Jonathan on the right side. A few months later, by August, actually Samantha would have not only recovered, but actually had a 10% improvement in regional investment, so from 100,000 to 80,000 and back to 110, while Jonathan that have left the market sometimes in between February and March and then re-entered in April would actually not made up yet to the losses. It would actually be still 6% down. Another example is if you look at what happened in 2008, 2009. In practice, Lehman Brothers went bankrupt in October, and between October and March 2009, markets went down around 55%. So if you decided to stay out of the market during this market rout, there is no way that in March 2009 you would have said, oh, let me now invest everything in the market, because news were very poor. You would have read on a newspaper that company X was firing and company Y was also letting go people. Your friends would be let go by companies. So you would have been in a very pessimistic mood. If you had been out of the market until March 2009, you would have stayed out of the market also in April and in May. The market rebounded very strongly. And by May, June, you would have started asking yourself questions about, should I get in, should I back in or not? And the natural answer, if you had stayed out until then, would have been, let me wait for the next leg down. And you know what? The next leg down never happened. And you would have lost the biggest bull market in the history of markets. So don't try to use your cash position to time the market. Now, back to the main topic of today. you still should have some cash. So how much cash should you have? What is the Y% I mentioned earlier? You should always have 1 to 2 months of cash available in your current account, available for immediate expenses. And then you should have, 6 to 9 months worth of expenses in an account that is liquid, low risk, and gives you some money. You don't want that at 0.05% in your bank. In particular, this last point has become more important over the last few months. What you see here on this slide is for the last 13 years, rates on Singapore dollars and US dollars. So SORA is the Singapore dollars overnight rate, LIBOR, in this case, is the US dollar LIBOR. The blue line is LIBOR, the purple line is SORA. And what you can see is that for the majority of the last 12 years, these numbers have been below 0.5%, within 0.5%, with an exception around 2018, 2019 pre-COVID. So reality is that you could have left your cash in your bank account, giving you 0, and it would have been fine. That's not the case anymore. US dollar now gives close to 5%, actually 5%. Singapore dollars gives around 3.5%. You want to make sure that the cash you have still gives you some returns. And this is why we decided to set up this webinar tonight. We're going to talk about exactly this. How do you make sure that you're not getting 0% in your cash, you're not getting 1% in your cash, you're not getting 2% in your cash, you're getting north of 3.5% for Singapore dollars and around 5% for US dollars, okay? From a StashAway perspective, we offer 4 cash management products, 3 of which in Singapore dollars, 1 in US dollars. We call them StashAway Simple for Singapore dollars. So we have Simple, Simple Plus, and Simple Guaranteed. And US dollars cash management is a more kind of a less interesting name, US dollar cash. So the projected rates, as you can see, varies from 3.5% for Simple, 4.6 to 5% for StashAway Simple Plus, and 3.4% for Simple Guaranteed. While in US dollars, right now, we're able to give 5.3%. I'm not going to read through everything here. The core is that Simple and Simple Plus have daily liquidity, are either ultra low risk or slightly higher risk. We'll talk about them in detail because the underlying funds are actually managed by Wai Hung and Toh Chieh. So this is exactly the focus of the conversation later. So Simple and Simple Plus are de facto funds that are managed by them. They have incredibly low pricing at 0.15 to 0.2% after the 1st of July. And the purpose here is StashAway Simple is absolute liquidity, T plus 1 liquidity, ultra low risk. Simple Plus have also the same liquidity, but because it takes a bit more maturity risk, you might want to have, this is for money that you don't need maybe for the next few months. Simple Guaranteed is invested in fixed deposits, and so it is a guaranteed return, guaranteed by a bank. And as of now, if you invest today in Simple Guaranteed, it's going to be guaranteed by Citi. Actually, in the app, you'll find out what is the bank. Right now, it's Citi. In each of these cases, for all of our products, there's no minimum, no maximum. So you don't have the issue that you might have with some of the banks that you have a minimum $5,000 or minimum $100,000 and maximum $200,000. And in some cases, you get a certain return between $50,000 and $70,000 and another return between $70,000 and $100,000. We call this simple for this reason. It's simple. There's no minimum, no maximum, no rules. It's very, very straightforward. You can withdraw anytime you want. No minimum time invested other than for Simple Guaranteed, which is a fixed deposit. Okay. US dollar, as I mentioned, 5.3%, also extremely liquid, currently free as well, charging 0.3% per annum starting on the 1st of July. Now, how does this product compare to what else is available in the market? Let me compare to a few different things. So on the left side, you have Simple, Simple Plus, and Simple Guaranteed. So obviously, first alternative is saving accounts. Depending, obviously, this is a very broad word. So where you have different type of interest. The example you have here of 1.5% is from DBS, assuming that you actually credit your salary and you're using a credit card. Otherwise, you're only going to get 0.05%. So 1.5% is actually on the higher side. If you invest in T-bills, which are kind of government bills, no coupon of 6 months or 12 months, the average yield at the last auction was 3.26%. And this is what is important is the actual average yield. Don't look at the initial or the highest bid. What matters is the average yield. And obviously, it's a bit complex to actually go through that. If you want to invest in FGS bonds, the average yield at the last auction was 2.58%. The process is a bit similar from T-bills. And if you look at Singapore saving bonds, which are limited at $200,000 maximum, you actually at the last auction you would get actually 2.81%. Yeah. So this is to show you that there are a number of alternatives for cash management. The ones that I'm proposing here on the left side are actually quite competitive. This is all the Singapore dollars alternatives. And obviously you have fixed deposit at other banks. I'll actually going to go into the details of this in a second. But let me focus first on Simple and Simple Plus. So these are Simple returns since we started in November 2019. As you can see, is extremely reliable, extremely steady. And the reason is that it invests in 2 money market funds that hold to maturity and don't mark to market. I'll have Toche explain that maybe later, because both funds are actually managed by Lion Global. As you can see, the promise with Simple is very, very steady returns that are, whatever we're promising today. Obviously, what we're promising today is higher than what was promised before the rate cycle some time ago. So you can see that the slope of the curve is actually steepening over the last few months. Simple Plus, this is the performance year to date, moves a little bit more, as you can see. So it's not as steady because it takes a bit more maturity risk. And that's why we recommend to people for Simple Plus to have a bit longer holding maturity. If you invested in at the end of January, you might have experienced a month or two where actually, returns have been flattish. And that's why, but it takes time. So it goes a bit more up and down depending on how interest rate move in the short term. But as you can see, actually, giving it, this is 4 months, it is doing exactly what's supposed to be doing. So 1.5% in 3.5, 4 months, which is consistent with what the yield to maturity that we've been discussing earlier. So the yield to maturity for Simple Plus is now, as I mentioned, published at 4.6 to 5%. The latest data is actually 4.9%, to be precise. Now, this is for Simple and Simple Plus. Let's look at Simple Guaranteed for a second before we start the conversation with Wai Hung and Toche. So we thought it made sense to compare Simple Guaranteed, which is investing in fixed deposit at Citi right now, with whatever else is offered in the marketplace. So we compare here with DBS, OCBC, and UOB. So the rate for DBS is now 2.9%. These are 6 months fixed deposit, as you can see from the tenors line. So rates are now 2.9, 3.2, and 3.1% for the major banks. Simple Guaranteed is offering 3.4%. There is a minimum and maximum. In the case of DBS, there is a maximum of $20,000. In the case of OCBC and UOB, there is a minimum of either $10,000 or $20,000. In our case, I mentioned there is no minimum, no maximum. Onboarding can be, easy, of course, if you already have an account with one of the primary bank, and easy for us, whether you have an account with us or not. We make it extremely easy. It takes 7 minutes to open an account, especially if you have my info. We don't offer a promotional rate. So what we offer is a rate that is, continuously valid. So you can expect the rate to be there and around there. Sometimes, of course, we'll adjust it as interest rate will go higher or lower. But this is not based on a promotion. This is our product the way it is. From a risk perspective, you're taking the fact of Citi balance sheet risk, which obviously is as close as it gets to zero, and there is no other conditions. So we think we launched Simple Guaranteed only a couple of weeks ago. We think we put in the market something that is actually quite interesting for people that are looking for a guaranteed return. If you're not looking for a guaranteed return, obviously, as showed earlier, there are, you can actually, Simple is actually offering a slightly higher return right now, not guaranteed, but very stable, while Simple Plus is offering 1.5 percentage point more, not guaranteed, with a little bit of volatility, but still with a where we are in the interest rate cycle. We're going to talk about it with Wai Hung and Toche very soon. I think it's quite prudent to think that the yield to maturity will continue to be decent for some time. So before we start the conversation, let's look inside this product. So Stashaway Simple invests 30% of his holding in a Lion Global money market fund and 70% in a Lion Global enhanced liquidity fund. As mentioned, we have Toche here from Lion Global, so I'll ask him a few questions shortly. Stashaway Simple Plus invests 45% in a Lion Global short duration bond fund 20% in the Lion Global Enhanced Liquidity Fund, the same that Stashaway Simple invest in, and 35% in Nikko Short-Term Bond Fund. And here we have both Toche and Wai Hung, who will be able to talk in more details about it. Simple Guaranteed, as I mentioned, is the underlying as fixed deposit. Right now, the fixed deposit with Citibank. Over time, we might change bank, as you know. Obviously, whenever you place a Simple Guaranteed deposit, you will know which bank you're placing it with, and that will never change. Like if it's Citibank, it will Citibank for the 6 months, and Citibank is guaranteeing your returns. If we ever change banks, you will know before you click. And then lastly, the US dollar cash management underlying is 99% in a money market fund that invests in US treasuries. Average maturity is 1.5 months, so it's incredibly short. Enough from me. Thank you for listening, and thank you, Toche and Wai Hung, for being patient. I just wanted to kind of set the stage a little bit and talk a little bit about what we offer as a company. Let's maybe start the conversation. Maybe Wai Hung, do you want to start? And can you give a little bit of an overview of Nikko as a fan house, and maybe a quick introduction to the fund we were talking a second ago, so the short-term bond fund that you manage, that we use in Simple Plus.
Sure. Just a little bit info on Nikko. With asset managed AUM about more than $200 billion. I think Nikko is one of the largest Asia-based asset manager. And particularly here in Asia, we manage the Asia asset for whether be the equity or fixed income for the whole Nikko group. So specifically for the Asia fixed income, we manage about 11 billion within the whole Nikko group. So for this short-term bond fund, is basically one of the oldest unit trusts here that is launched in Singapore. It's basically a very consistent strategy that we have been managing since day one, with holding a wide diversified portfolio of short high grade bonds that trying to give the investor a very stable returns arising from these bond holdings.
Thank you, Wai Hung. Toche, I'll ask you the same question. Can you maybe talk briefly about Lion Global and the 3 funds actually that we use between Simple and Simple Plus?
Yes, sure. Lion is owned by OCBC Group and Great Eastern, so we are the fund management arm of the OCBC Group, and I'm sure the audience here they are all familiar with OCBC. So we manage third-party funds. At the same time, we do manage the insurance funds from our parents. The 3 funds that you spoke about, so this is our suite of product for the cash management tool. Now, the 3 funds will be the money market fund, the enhanced liquidity fund, and the short duration bond fund. So starting with money market fund, that is the safest. The rating is A+, has a duration of 0.25 years. This is a very high quality money market fund. Now, we added a bit of risk, and that would be the enhanced liquidity fund. For now, the enhanced liquidity fund duration is similar to that of money market fund, which is around 0.25 years. The yield of these 2 funds are also similar. They are all in the region of 3.8%. And this is because, as McCarthy mentioned, the cash rates have risen, has gone up recently, right? So we are taking this opportunity to invest in the very short end. And therefore, for now, the yields of these 2 funds are similar. But if eventually the market will normalize, where, the curve will normalize and no longer be inverted. In that environment, the enhanced liquidity fund, as it should be, the yield would be higher than the money market fund, right? Because of the nature of the yield curve. So those are the 2 funds, right? And your Simple is invested into these 2 funds. Now, the 3rd fund is the short duration bond fund. Now, this is the fund that takes on more risk. The duration is 1.8 years. It invests into BBB names. So therefore, the average credit rating is BBB. The yield is also higher, right? On the unhedged basis, the yield is 3.8. If you hedge it back to Sing, it's still above. I beg your pardon. On the unhedged basis, the yield is 5.8, and even after hedging back, your yield is still above 5%. So that in short is the summary of the three funds.
Perfect, thank you. And so just to for clarity to clients, so you talked a little bit about duration or average maturity, and the combined maturity of the simple products is around 4 months right now, and the combined maturity of Simple Plus is 1.2 years. So that's where the kind of a duration risk and volatility comes about. So maybe let me double click on this too. When you think about investing in money markets and short-term bond funds, you can look at risk with maybe two lenses. One is a duration and interest risk lens, and the other one is a credit risk lens. Wai Hong, can you maybe talk a little bit about those two lenses with regards to the ultra short bond fund that we are using in Simple Plus?
Sure. So you're absolutely right. For the main source of return or risk for short-term bond fund, right, that we manage are basically arising from the base rate. In this case, is the if you invest in a dollar, will be the US Treasury. When you invest in the Sing dollar space, will be the Sing base rate. And on top of that, you have your for every credit bond, you have the credit spread that you're investing. And also, just to be fresh, be sure for the short-term bond fund that we are referring to, these are, as I say, these are basically the two main source of return. We do not dabble into FX risk for this one. And so within this rule risk on the durations, just let's start with the duration, which is the base rate, right? As you know, the Fed has been very aggressive. I think this is one of the most aggressive rate hike cycle that the whole market has been experiencing, in terms of for them to trying to fight this stubborn inflation. So since last year and even into this year, this fund has been very defensive positions in terms of durations. We have been capping the duration pretty short. As we started the year, almost like about 1 year into the durations of average durations. But if you look at how the pace of the cycle and also expectation of the Fed fund rate, right? Given that we are expecting the Fed fund to basically have a pause in the next meeting, I think the kind of pace of rate high, and also in the beginning of the cycle, we are having adding duration to the portfolio. I think in terms of the market, I think that's a decent timing, especially with the recent sell of the base rate, not related to anything but more of the noises on the debt ceiling issues. Then on the credit side, as you mentioned just now, again, it's a very how we manage it is basically holding a very wide broad diversified of high grade portfolio. And in this sense, if you look at the portfolio itself, it's basically have almost like 90 over nice in terms of portfolio, and 25%. When you look at the top 10% of holdings, is just about 25% of the portfolio. So it's basically a very highly diversified credit positions, and we don't even the fund doesn't invest in the high yield. The average portfolio rating is a very solid A- ratings. So this is basically how we try to give a very stable return to our investor into that actually invest in this fund.
Perfect. Thank you, Wai Hong. I moved to this page because there was somebody listening that was asking to see which fund everyone was talking about. So in this particular case, Wai Hong was talking about the Nikko short-term bond fund, which comprises 35% of StashAway Simple Plus. Toche, same question to you. When you think about kind of credit risk and duration interest risk, and then later I'll ask you guys about kind of how you think about interest rate going forward. Wai Hong, you mentioned a little bit already. But when you think about credit risk and duration interest rate risk, how do you think about it for the three funds that we're talking about? So, for the benefits of everyone listening, we're talking about Lion Global's money market fund, an enhanced liquidity fund, and the Lion Global short duration bond fund.
Right. So I'll start with the two so-called money market fund, right? So the money market fund and enhanced liquidity fund, these two funds are very conservative. The duration is 0.25 thereabout. They invest in very high quality. The rating is A+ and A- respectively. So and at the same time, they're being priced at the amortized cost basis, meaning that it's done on the accruals, all right? So in a way, in the absence of default, the price will not drop because every day you just accrue based on the yield. Now, if you move to the other end of the spectrum, our short duration bond fund. Now, this is the fund that takes on a bit more risk. Now, as you know, when you invest in bonds, there are three main risks, as what Wai Hong has alluded to. Now, first of all, FX risk, right? That the fund doesn't have FX risk. We hedge out almost all the risks. So 99% would be in the base currency, which in this case is Sing dollars. Now, after hedging away FX risk, what remains would be duration and credit. Duration, we keep it short. In this case, our duration is 1.8 years. Just to a quick digression, how do we come up with this 1.8 or two numbers? The way we look at it, if you shock the interest rates on a normal shock of maybe 100 basis point, to have a 2-year duration, you tend not to lose money. So that is roughly how we came up with a 2-year duration number. And in this case, our duration is less than 2, it's 1.8. Now, what are we left with? We're left with credit risk. And that's the risk that we want to retain for this fund, right? And as you mentioned, we do have a diversified portfolio. We have more than 150 names invested into this fund. And this fund is also diversified geographically, not just by the countries we invest in, but by the markets. And what do I mean by that? The fund buys, half of the fund is invested into the Sing dollar bond market, and the other half will be in the US dollar market, right? While both are bonds, they kind of operate in a slightly different, universe. The Sing market is in a way less liquid, but at the same time, you can kind of argue it's more stable. And the dollar market being a broader market, that there are more names for us to choose from. Now, within the credit rating category, a bit unlike Wai Hong, we do have a 5% allocation to high yield, but we don't necessarily maximize or utilize this. Currently, we are less than 2% into the high yield market for this fund. And we do believe that having a small amount of high yield does add to the yield of the portfolio. It does juice up the yield so as to give investors some form of risk-adjusted return. That's the quick summary of the three funds.
So thank you. So let me maybe switch gear and double click on the interest rate or duration risk for a second. So to give people's context, as both Wai Hong and Toh Chieh mentioned, as I showed you earlier, over the last 12 months, we went through an unprecedented, super fast increase in interest rate. The US dollars went from 0% to 5.25% in 13-14 months. And Singapore dollars followed, it's slightly below, but followed at more or less with the same speed. That obviously had a significant effect on the market we're talking about, of fixed income and bond instruments. And maybe one thing that not everyone is aware of is that when interest rate goes higher, your bond price goes lower. So it's inverted. So if your yield goes higher, the price of the bond goes lower. And therefore, during 2022, some of the bond funds, the longer duration bond funds would have actually lost quite a bit of money. The shorter duration bond funds would have lost less, but still some money. As I showed you earlier, the Stashaway Simple, so the money market funds and the enhanced liquidity fund actually were very stable because, as mentioned by Toh Chieh, they are managed in a different way, and they are kind of amortized and held to maturity. And so it worked actually very well last year. That's actually the reason why we didn't launch Simple Plus until end of last year. Now, question for you guys is, obviously this works on the other way around as well. So when interest rate goes down, the yield will decrease, but the price of the bonds will actually spike. And so will actually, give your, de facto promise your yield to maturity. Where are we in the cycle? Like, what is your house view? And what do you therefore expect in terms of price movements for the funds we're talking about over the next 6 to 12 months or whatever you have visibility on? And I guess, Tochi, we shouldn't talk too much about the money market fund and enhanced liquidity fund because they don't move too much. I mean, the yield may go up and down, but actually they tend to be extremely stable. So maybe let's focus on the bond funds. Tochi, do you want to start?
Yeah, sure. So as you mentioned, last year was unprecedented. We have such a fast and absolute large amount of hikes. And at the same time, inflation has proven to be sticky. We do have to bear in mind that inflation has turned. Now, it's not coming down as fast as what the Fed would like it to be, but we need to remember that monetary policy or the impact of the hikes, it does take time to filter down to the economy and therefore inflation. And this lag is something that's unknown, and you can't quite predict that, right? But we know that the impact is there and it's coming. So as Wai Hong has mentioned, the market is expecting Fed to pause, but at the same time, the Fed members themselves don't quite agree on that, right? So that's one point. But if you look at the projection beyond this year and next, both the Fed and the market agrees that Fed rate should come down from current 5% to 3%, right? So that's something that both market participants and the Fed members agree on. So in other words, everyone agrees that Fed rates has to come down over the next 2-3 years. With that in mind, so as investors, we have to look beyond this year, right? So a lot of debates or a lot of articles you read is about, what is Fed gonna do next month or next quarter? But we're not investing for next month and next quarter, right? We're investing beyond this year actually. And we are of the view that the Fed hike is at its peak. Maybe they might hike one more time, but beyond that, right, rates have to come down. So if that is the background, then therefore we are of the view that today's rates are very attractive, right? And therefore, if rates were to come down, then therefore today is a good time to put your money to work. Yeah.
Thank you. So what I'm hearing is your house view is we're more or less at peak interest rate or just below that, and therefore interest rate risk is very, very low for funds. Actually, there's probably more upside than downside on these short duration bond funds. Wai Hong, what is your house view?
Oh yeah, as I mentioned earlier, I think what we're thinking, viewing of is basically quite in line. I mean, concur with that. I think in terms of the rate high cycle, I think this is where the main source of performance or underperformance that we have seen in last year, right? I think that fear of investing into whether equity or fixed income, I think it has basically have a reverse, given where we are right now in terms of the rate high, in terms of and more so in terms of the subsequent impact on the economy, like what Tochi mentioned, in a sense, your expected growth, and also if you link it out with a weaker growth, I think fixed income should be where investors should be in terms of asset class. So that's very similarly, and you look at this also what Tochi earlier in the presentation mentions, right? In terms of the shape of the yield curve, whether is it on the US strategy or in the Sing dollar, it's basically inverted at the short end. So we know that this will normalize as economic cycles normalize, the rate hike cycles normalize. And this is exactly, if you look at this, is exactly where that's where this short-term bond strategy, and this is is actually offering a very attractive proposition for investor to basically potentially benefit from the normalize of the yield curve.
Understood. Thank you, Wei-Hong. And so maybe let me stay with you for a second. We talked about duration risk. You talked about credit risk earlier. There is a lot of talk about U.S. economies potentially going into a recession, and who knows whether that also makes kind of the rest of the world goes into a recession. Do you think that that will change the credit risk profile of the fund you manage?
Not too much per se, in the sense that, as I mentioned, we are basically, as this particular fund, we are focusing very much on quality. We are not chasing we never chase the widest yield the offer out there in market. And in the scenario that you have painted in terms of the expected recession, even we don't whether a recession will occur this year or next year, it doesn't matter. But as a whole, the economic cycle, the expectation of growth is expected to be slower in a 1-2 year horizon. So as a credit investor, you look at the credit cycle. This is where the part of cycle that one should not be too aggressive going down the credit curve, especially what we have seen in the US in this year in terms of bank failure. The tighter financial conditions, I mean, it's not even in US, it's more so on a global scene. And this tighter financial condition will actually be more basically impact more so on the weaker credit. And so for this fund that actually focus mainly on credit that we deem of a very high quality, and that has basically have access both on the offshore or onshore market, we generally tend to avoid credit that actually focus that has a lots of maturity or huge maturity work in the near future that actually have basically would have a hard time facing refinancing risk.
Understood. Thank you. And Toh Chieh, on your side,
Yep.
How do you think about potential changes in credit quality or credit risk given potential impending recession?
Right. So pertaining to the short duration bond fund. So first of all, we are invested largely in Asia. So to the extent, the credits invested in the companies are resilient. So even in face of a US recession, we believe that the credits are still solid. And I might want to add that in a recession, it's actually good for bonds, right? Because rates have to come down, and that improves the bond prices that we are invested in. So I'm not too concerned about a US recession. I actually welcome a US recession.
Makes sense. And maybe to be clear, for money market fund and enhanced liquidity fund, no real impact, right?
No impact. We are single A, solid companies.
Perfect. And very short duration, 0.25. So
Very short duration. In fact, a lot.
3 to 4 months. So it's an incredibly short duration. So real, very, very, very solid.
That's right.
Perfect. Thank you. Maybe one last question before I ask you for closing thoughts and we go for Q&A for clients Q&A. How do you expect the yield to maturity of your funds is what then we actually use as yield to maturity for our clients. So for instance, Simple is currently yielding 3.5% because that's the average yield to maturity of the money market fund and enhanced liquidity fund. I mean, obviously weighted. And Simple Plus has currently yield to maturity of 4.9% because that's the weighted average of the yield to maturity of the 3 funds we use there. Where do you see yield to maturity moving, given what we talked about? So given interest rate around peak right now, potentially slowing down, recession potentially coming in, which would probably mean interest rate going down faster. Where do you expect yield to maturity to move in the next 6 to 12 months? Toh Chieh, we want to start?
Okay, so on the two, the money market fund and enhanced liquidity, they're very Singapore centric, right? So if you are aware today, MAS just published Singapore's inflation. It turns out to be higher than what the market expected at 5%. Market was expecting 5.4. This is sorry, market is expecting 4.7. It came in at 5. This is the core CPI. The two funds are invested a lot into the short end of the curve, specifically MAS bills and T-bills. And we believe that unofficially, these instruments were kept at higher yield to fight inflation. And I mentioned earlier that the Singapore's inflation came in a bit higher than expected. In other words, we do expect the rates to stay high a bit longer. But having said that, 6 months' time, I do believe that the rates will come down, probably still above 3, maybe in the 3.4, 3.5 region for the two funds. For the short duration bond fund, it's more US centric. So on that front, I do believe it will come down faster to maybe below 5%.
Okay, and that would have a short-term positive impact on price, but a longer-term negative impact on yield to maturity in practice. So, whoever is invested at the time when the interest rate goes down will actually benefit. Whoever invests later will not benefit and actually will have a lower yield to maturity.
Yeah, exactly.
Thank you. Wai Hung, any different perspective?
No, quite similar. As in the short-term bond fund that we manage is still very much US centric. I mean, in the sense that well, we have quarter about investment in the Sing dollar space, but generally, I think the source of return is still coming from the dollar side. So very much mirror what the short end rate of the US Treasury is. I think against right now it's about 4. I think if the market is correct, I think we in the next 2 years so we probably have at least a 50 to 100 basis point upside from just basically on the base rate itself.
Perfect. So before I go into the Q&A, we have a few questions from clients. Let me ask you, any closing thoughts on how to manage spare cash and emergency fund, kind of extra cash you're not investing, and in the context of what we talked about right now, obviously there is quite a few options. Any personal thoughts on this?
Yeah. Okay. So because I have 3 funds here, right? So if you don't need your money for up to a year, you can keep it with the 2 money market funds, the money market and the enhanced liquidity. But so this is for money that you don't need, or rather you potentially need to use for the next 6 months to 1 year. Beyond that, then you can think about buying into the short duration bond fund.
Thank you. Wai Hung, any different perspectives?
No, I mean, since last year, I mean, if you're from a Singapore-based investor perspective, the sharp rise in the T-bill, MAS bill has drawn a lot of interest from the retail investors. But you can see that all these rates has been coming down. In fact, including the FD, right? And if our expectation, what we have discussed earlier on, our expectation is correct in terms of the duration and the base rate, right? Investing in the short duration bond fund is where you can basically benefit from the capital returns that actually coming from the rally in the base rate. So, and also if you compare to other more guaranteed product, invest in this fund, you have the daily liquidities. I think you have the best of both worlds.
Perfect. Thank you, Wai Hung. So let me go through the question that were asked by and please keep them coming if you have any further question. So I'll start with an anonymous attendee asking, are there any hidden fees? For instance, management sales fee payable that eat into the yield. I'll take this one. So the answer is no. Let me actually let me see if I can show you the page I showed you earlier with fees. The short answer is no, there is no hidden fee. The numbers we show are always, so you can see here, the line called pricing. So the yield we show is always net of any fee. Any retrocession that we receive from the fund managers, in this case, Lion Global and Nikko, as you might know, in the industry, most often than not, clients pay a fee to the unit trust, and the unit trust gives back some of the fee to the distributors. we actually don't do that. Any fee that we receive from Nico and Lion Global is actually given back to the clients. So the only fee you are paying is the fee you see here on the pricing line. It's extremely transparent, so you know exactly how much you're paying. Plus, obviously, the fee that goes actually to the fund manager for to pay for Tochi and Wai Hong's work and their colleagues, and kind of managing the fund. But no sales fee, no exit fee, no management fee other than what you see on this slide. So it's extremely transparent. Benjamin is asking, what's the difference between the simple guaranteed product and a fixed deposit of 6 months with Citibank? The short answer to that is there's no difference, except it's much easier to do it with us, and especially if you don't have a Citi account. And because over time we might actually pick, to partner with a different bank, depending on who has the right mix of best rate with strong solidity of the bank. So we're not gonna go to a higher yield for a not so strong bank, but we have the ability to pick a different bank with the same solidity of Citi. We actually will be able to offer you always the best combination available in the market. But the short answer to the question, what is the difference between simple guaranteed and a fixed deposit of 6 months with Citibank, is de facto zero. Like you are investing in a 6 months Citibank deposit. Because we get preferential rates from Citi, depending on what's out there, obviously Citi Retail Bank runs promotions or might not run promotion at a certain point in time. You'll find our rate, better than what is available with Citi or not, depending on whether Citi currently has promotion for retail or not. What we get because of our volumes is obviously a better rate than what you would get normally from Citi. There is a question on how is the Simple and Simple Plus different from similar Endowus products. I don't like to talk about people that are in the room, so I'm not going to compare directly to Endowus or to anybody else. What I can tell you is where we think our products excel. I think in general, Simple has been extremely stable, as I showed you earlier. You don't find at the level of yield that we offer, there is no other products in the market that is that has been as consistent and Simple. Thanks to the way we've structured it, and thanks obviously to the work of Lion Global in the back. And similar for Simple Plus, actually we offer I think the highest rate in the market right now with the lowest volatility. So if you actually risk adjust the yield that we've given to clients over the last since we launched in October last year, I think you'll find that there is no comparison. In addition to that, it just the app makes the user experience extremely simple. We excel also on in terms of availability. You can always, we pick up the phone in less than 8 seconds. You can always WhatsApp with one of our customer support team members simply from the app. So we try to make the experience as easy as possible. In addition, we also, nobody else offers a product like Simple Guaranteed as part of the digital players, and nobody else offers a US dollar cash management product like offering more than 5%. So I think the suite of products is a bit more complete than what you see from other players in the market. What is the year-to-date return on Simple and Simple Plus? So the annualized return on Simple Plus is actually higher than what we promised, around 6.9% so far in the 6 months annualized. And on Simple, 6 months annualized is actually slightly lower. It's around 2%. It's been picking up over the last few months. So the yield to maturity right now is what we published, but in it has it was a bit flattish during February, during the February-March period. But now it's the yield to maturity is exactly what is promised. Varun is asking, what is the next 6 to 12 months US market outlook? I mean, this is obviously a question that will potentially take an hour to answer, but let me ask you guys, Tochi and Wai Hong, if you have a house view on this. So the question is very simple. What is the next 6 to 12 months US market outlook? Then maybe I'll give our perspective after you guys. Tochi,
maybe I go first. So I presume this is with regard to the bond market, right, since we are talking about bonds. And as I mentioned earlier, we know that rates have gone up a lot, right? Fed has hiked. But we're still seeing the impact on the US economy. It's not fully felt. And as I said earlier, that there's a lag, or rather there's an uncertain lag between monetary policy and economy and inflation. That said, we are seeing the impact on certain parts of the US economy. So, for example, housing was affected. What's not affected has been the US labor market. Now, on the consumer side, they are still pretty strong, right? But having said that, the US consumer, they still have pretty high savings as a result of the government transfer during COVID period, much like what we have in Singapore, right? The residents or citizens were given cash to spend. Now, in the US context, to put some numbers, the savings were at one point at the peak was 2 trillion, right? That has dropped, and based on the current rate they are spending something like 100 million a month, and that speed of spending will roughly last them to end of this year, right? And of course, when savings is gone, US consumer will be affected, right? So that is one key factor that we're looking out for, and obviously that means that the US economy would slow down. So on that front, we are bearish on the US economy, and therefore from the fixed income or from the bond market point of view, we are constructive, meaning that we think that interest rates will drop, and therefore that will be good for bond prices. So that in short is my outlook for the next 6 months for the US bond market.
Thank you. Wai Hong, anything different?
In general, not too different. Maybe I add a little bit more on what Toh Chieh mentioned. Right? If you as the background as painted by Toh Chieh, right? So I think if US is really enter into recession, I think with what Toh Chieh mentioned is going to this cycle with a better footing from the consumer side. I think it will be more of a shallow than a deep recession than what we have seen previously. And that means that also what happened in US economy will have impact on the Asia economy, of course, because it's all correlated in terms of trade. Right? So again, with the transition will not be too large into the Asian economy, and with the Asia corporates that we are investing, I think they definitely have a better footings. And also in terms of, then I'll talk a bit more about the bond market. Then in that sense, if an investor can invest in a US credit versus the Asia credit, whether Toh Chieh fund or all my funds are basically investing in, I think that's an easy pick, based on either on the economy as well as basically based on the economy cycles. So that's what we are thinking.
Thank you, Wai Hong. Now there is a colleague of mine that just told me actually, when you compare with Citi simple guaranteed, somebody was asking earlier about simple guaranteed versus fixed deposit, and I said, the logic is the same. You're investing in the fixed deposit with Citi. The rate might be different depending on what promotions Citi has. We tend to be higher because of what we get. My colleague of mine just wrote to me saying that we're actually significantly higher than what you can get with Citi. So apologies for not being clear earlier. And as I mentioned, it depends on the promotional rates, and banks have actually reduced promotions recently, and so you're not going to be able to get what we get for you directly. One of the things that a lot of banks offer promotional rates if you put fresh funds, so you can only use it once. While in our case, obviously, it's always it's always available depending on whether it's fresh fund or stale fund. We don't care. You always get the same amount of rate. Now, 2 more questions. Last 2. One is for you guys. Can the funds buy into perpetual bonds? Toh Chieh.
Yes. So the true money market fund doesn't buy. In other words, the money market fund, the enhanced liquidity, does not buy into perpetuals. The short duration fund does. It has about, I believe, around 15% into perpetual. But I need to clarify a bit. We buy whenever we buy into perpetuals, we look at what is known as a step up, meaning that if they do not call, they have to pay a huge penalty. The coupon will step up to a very high rate, such that it becomes too big, such that the corporates will be incentivized to call back the bonds. right? So that's for corporates. So we do buy into corporate perpetuals, but we do not buy into bank perpetuals. I don't have too much time to elaborate on this, but the banks that we buy into are callables, and they are tier 2s, not the tier 1s that, you know, obviously has a bad name because of Credit Suisse.
Thank you. Wai Hong.
No, we don't invest in perpetual for this short-term bond fund. It's not that as a firm, it's not that we don't like perpetual, but for this specific strategy that we are managed, we do not try to throw in a long call risk for our client, in the sense that if a perpetual does not being called, right, and as you know, it will be a price of a 30-year bond. So yes, we buy a callable bonds, but more on the on bonds that have a fixed maturity, but not a perpetual, which is, as you know, if you don't call, will be a perpetual in nature.
Thank you, Wai Hong. Now, last question from Charles. For my spare cash with a 1 to 2 year horizon, should I consider a money market fund, Simple Plus, or a conservative portfolio such as BlackRock Conservative for more possible upside? So BlackRock Conservative or Stashaway Risk Index 6.5%, 8%, 10%, which is the lower risk side of our multi-asset portfolios, have, as you mentioned correctly, a little bit more risk because they have a bit more maturity. And therefore, you know, in theory, they run a bit more interest rate risk, as well as they might, once you start going to 8, 10, 12%, you start also having a little bit of exposure to equities and perhaps, perhaps exposure to gold, for instance. We usually say that up until 1 to 2 year, Simple Plus is the right product, particularly now, given where interest rates are, where you actually get a very nice, 4.6 to 5% yield. But obviously, when you start to get into the 2 to 3 years mark, also investing in one on a conservative portfolio, as you mentioned, can potentially give a bit more upside because of longer maturity. So if the economies were to go in a recession and there was a reduction in interest rates, it would actually potentially increase a lot. Now, one important thing is that Simple Plus is in Singapore dollars, so you de facto do not have any currency risk. The BlackRock Conservative, as well as the Stashaway Risk Index 6.5%, 8%, and 10% are in US dollars, so you have currency risk. So depending whether you think in US dollars or Singapore dollars, the answer to the question is different. If you think in Singapore dollars and it's a cash that you need in 1 to 2 years, I'll definitely tell you go to Simple Plus or potentially the income portfolio, but I would probably recommend Simple Plus right now for this short time horizon. If you're thinking US dollars, then your question should be US dollar cash management versus BlackRock Conservative or Stashaway Risk Index 6.5 to 10%. And as I mentioned, depending on your risk or sorry, on your timeline, US dollar cash management can be even for 1 month. So definitely, up to 1 to 2 years as well. But, above 1.5 to 2 years, you might want to kind of take a bit more maturity risk, especially because everybody expects the interest rate to go down over the next 12 to 24 months. And therefore, there is some upside there by taking a bit more duration risk. I don't see any other questions. And I also know that we overshoot by 5 minutes what I promised to Tochi and Wai Hong. I promised to close at 8. So I just want to thank you, Wai Hong and Tochi. I want to thank everybody that logged in tonight. And we had quite a few people actually listening in, a lot of questions. So hopefully this was instructive and interesting for people, and people will not leave their cash at 0.05% in their bank account, and just think about it tomorrow so that you can actually make your cash work for you. Thanks again, Wai Hong, Tochi. It was a pleasure having you. Hopefully we can do this again soon. And thanks everyone for joining. Have a very good night.
Thank you.
Thank you.
Thank you.
Thank you.